Today, we're going to dive into the world of real estate financing. We'll explore not just mortgages, but also the various options beyond traditional loans that can help you navigate the complexities of funding property purchases. Understanding these options is crucial, whether you're a first time buyer and investor or someone looking to leverage real estate for financial growth. Let's take a closer look at how real estate financing works and what opportunities it offers. On this slide, I'll walk you through the key skills you'll master throughout our discussion on real estate financing. First, you'll learn how to analyze different mortgage types, rate structures, and amortization methods. This will help you understand how various loan terms can significantly impact the overall cost of borrowing over time. Next, you'll be able to calculate loan payments and compare financing options using essential formulas applicable to both residential and commercial lending. Finally, we'll focus on evaluating investment strategies and lending decisions by interpreting repayment forecasts and loan data, while considering the balance between risks and returns. These core skills will give you a comprehensive toolkit for making informed financing decisions in real estate. A mortgage is essentially a loan specifically designed for purchasing real estate, where the property you're buying acts as collateral for the loan. This means if the borrower fails to make payments, the lender can take ownership of the property. The borrower repays this loan over time through scheduled payments that typically consist of two main parts: the principal, which is the original amount borrowed, and the interest, which is the cost of borrowing that money. Understanding the core terms is crucial. The principal is a loan amount, while the interest rate determines how much you'll pay in interest over time. The amortization period refers to the length of time it takes to pay off the loan completely, usually measured in years. The term is the length of the loan agreement before it needs to be renewed or renegotiated. Payment schedules dictate how often payments are made, such as monthly or bi-weekly. Finally, the collateral is the property itself, which secures the loan. Together, these terms define not only how affordable mortgage payments will be on a month-to-month basis, but also the total cost of the loan over its lifetime. This structure shapes how real estate financing works and determines the financial commitment involved in buying property. Let's break down some key concepts in real estate financing, focusing on principal, interest, and amortization. First, the principal is simply the amount you borrow. Each payment you make reduces the original loan balance, which means you're building equity as your debt decreases. Next, there's the cost of borrowing. Lenders charge interest on the unpaid balance, so both the interest rate and the loan term significantly affect your total borrowing cost. It's important to understand how your payments shift over time. Early in the loan, most of your payments go toward interest, while later payments apply more toward the principal until the loan is fully paid off. This process of gradually paying down a loan through regular payments that cover both principal and interest is known as amortization. Keeping these concepts in mind helps you understand how your loan works and what drives the cost of financing real estate. Let's talk about fixed-rate mortgages, a popular type of real estate financing. With this option, the interest rate stays the same throughout the entire loan term. This means your monthly payments for principal and interest remain consistent over time. That stability makes it much easier to plan and stick to a budget, since you won't have surprises with payment increases. Plus, fixed-rate mortgages protect you from any future hikes in interest rates, giving you financial peace of mind throughout the life of your loan. Let's talk about adjustable rate mortgages, or ARMs. These loans start with fixed interest rate for a specific introductory period. This could be 3, 5, 7, or even 10 years. During this initial term, your payments are stable and predictable, which can be a big advantage if you want lower initial payments compared to a standard fixed-rate mortgage. This initial rate is often called a teaser rate because it's usually lower than what you'd get with a fixed-rate loan. Once that initial period ends, the interest rate adjusts periodically. This adjustment is based on a market index plus a fixed lender margin, meaning your payments can go up or down depending on market conditions. However, there are limits in place, like periodic caps and lifetime maximum rates, to prevent your payments from increasing too much at once or over the life of the loan. So, while ARMs can offer lower early payments and flexibility, it's important to be prepared for variable payments after the initial term. Here, we're looking at interest-only mortgages, which can be quite appealing initially because they lower your monthly payments. However, It's important to understand that while these payments are smaller at the start, they delay the growth of your equity in the property. This means you're not building ownership as quickly as you would with a traditional mortgage. Additionally, because you're not reducing principal during this period, there's an increased risk when it comes time to repay the loan. So, while the upfront savings are attractive, it's crucial to weigh these benefits against the potential challenges down the line. This concept plays a significant role in real estate financing decisions. Let's talk about balloon payments in real estate financing. With a balloon mortgage, you make small, regular monthly payments for a set period. This could be 1, 3, 5, 7, or even up to 10 years. These payments are typically lower because they're often based on a longer amortization period, which means you're spreading out the cost as if you had a longer loan term. But here's the key part. At the end of that period, the remaining principal balance becomes due all at once. This final large payment is called a balloon payment, and it creates a significant risk. You either need to refinance the loan or come up with a lump sum payment, which can be challenging. So while balloon mortgages can offer lower monthly payments initially, it's important to plan ahead for that big payment at maturity. When we talk about amortization, we're really looking at how each payment you make gradually reduces your debt over time. First, every payment you make covers the interest that's calculated on the remaining loan balance. This means at the start, a larger portion of your payment goes just to cover interest. The rest of the payment then goes toward the principal, which is the actual amount you borrowed. This part reduces the amount you still owe. As you continue making payments, your loan balance gets smaller, so the interest part of each payment decreases. Because of that, more of your payment starts going directly toward reducing the principal. Over the life of the loan, this shifts the payments from being mostly interest in the beginning to mostly principal by the end. The key takeaway here is that even though your total payment stays the same each period, the way it's split between interest and principal changes. Early in the loan, you're mostly paying interest, while later on, you're paying down the principal more aggressively. Understanding this helps you see how your loan is structured over time. Here we have a typical amortization schedule for a 30-year loan with a fixed 5% interest rate and an original balance of $300,000. As you can see, the monthly payment stays constant at $1,610.46 throughout the entire loan term. However, the breakdown between principal and interest changes significantly over time. Early payments are heavily weighted toward interest, with only a small portion going toward reducing the principal balance. For example, in the very first payment, just $360.46 applies to the principal, while $1,250 goes toward interest. But as the loan progresses, more of each payment starts to reduce the principal. By the final payments, like payment number 360, you're paying almost entirely principal, dramatically accelerating the payoff of the loan balance. This schedule effectively illustrates how amortization works, balancing interest and principal, so the loan is fully paid off by the end of the term. Let's look at the mortgage payment formula, which is a crucial tool for understanding how your monthly payments are calculated. This formula connects the loan amount, the interest rate, and the loan term to determine the monthly payment you'll need to make. Here, M represents the monthly mortgage payment. P is the original loan principal or the amount you borrowed. R is the monthly interest rate, and N is the total number of monthly payments over the life of the loan. The formula itself, M equals P times, or times 1 plus R to the power of N divided by 1 plus R to the power of N minus 1. Looks complex, but essentially spreads out the loan repayment evenly over the term of the loan, factoring in interest. For example, if you take out a $320,000 loan at an annual interest rate of 6%, spread over 30 years, you first convert the annual rate to a monthly rate by dividing 6% by 12, which gives you 0.5% per month. The total number of payments over 30 years is 360. Plugging these into formula, the monthly principal and interest payment comes to about $1,919. Understanding this formula helps you see exactly how changes in the loan amount, interest rate, or term affect your monthly payment. This is essential knowledge when planning your real estate financing. Here, we're focusing on how to calculate the total interest paid on a loan. The key formula is simple You multiply the monthly payment by the total number of payments over the life of the loan, and then subtract the original loan amount. This gives you the total interest paid. For example, if you have a $300,000 loan at a 6% interest rate, the term length makes a big difference. With a 15-year loan, your monthly payment might be around $2,531, and the total interest paid over those 15 years would be about $155,683. On the other hand, a 30-year loan has lower monthly payments, around $1,799, but you end up paying much more in interest, about $347,514 in total. That's more than double the interest of the 15-year loan. This illustrates that longer terms reduce your monthly payments, but increase the total borrowing cost significantly. So, while longer loans may seem easier on your monthly budget, they cost you much more in the long run because of the higher interest. This is a crucial consideration when choosing your mortgage term. Let's talk about the loan-to-value ratio, or LTV, which is a key concept in real estate financing. The LTV is calculated by dividing the loan amount by the property's value. Essentially, it tells us how much of the property's purchase price is being financed through a loan. A higher LTV means a borrower has less equity in the property and, as a result, the lender is taking on more risk. For example, with a 60% LTV, the borrower has made a 40% down payment, which is considered low risk because there's significant equity built up. At an 80% LTV, the borrower puts down 20%, which is often seen as a benchmark. This is a common threshold because private mortgage insurance, or PMI, can often be avoided at this level, making it a sweet spot for many buyers. On the other hand, a 95% LTV means only a 5% down payment, creating higher risk for lenders and usually requiring PMI. Understanding these different LTV levels is crucial because it influences loan terms, insurance requirements, and risk assessment in real estate financing. Let's talk about points and closing costs in real estate financing, which are important factors to understand when securing a mortgage. Points are essentially prepaid interest, where 1 point equals 1% of the loan amount. You pay this amount up front to lower your mortgage interest rate. For example, if you have a $300,000 loan, 1 point will be $3,000 paid at closing. Now, closing costs are additional fees due at signing, including things like appraisal fees, title insurance, underwriting fees, recording charges, and lender fees. These costs add up and represent extra cash you need to bring to the table when closing your loan. The key trade-off here is whether you want to pay more upfront or pay more over time. By paying points now, you can lower your monthly payments and reduce the total interest you'll pay over the life of the loan. For instance, paying $3,000 upfront in points could reduce your interest rate from 6.5% to 6.25%. This example highlights how investing a bit more initially can provide significant savings later. So it's important to weigh these options carefully based on your financial situation and long-term plans. Here, we're comparing different mortgage options to help you understand their key characteristics. Let's start with fixed-rate mortgages. These have a stable initial interest rate, which means your monthly payments stay consistent over time, providing high predictability and relatively low risk. Next, adjustable rate mortgages, or ARMs, come with a low initial rate, but the rate can change over time, so predictability is medium with a moderate level of risk. Interest-only loans feature low initial rates and low predictability because you're only paying interest at first, which can involve higher risk since the principal isn't being reduced. Lastly, balloon mortgages also start with low rates and low predictability, but carry a high risk due to a large payment that's due at the end of the term. Understanding these differences can help you choose the mortgage type that best fits your financial situation and risk tolerance. When we look at residential mortgages, these typically involve 1 to 4 unit properties, either owner-occupied or rental homes. The loan terms tend to be longer, often ranging from 15 to 30 years. When approving these loans, lenders mainly focus on the borrower's income, credit history, and debt-to-income ratio. Residential mortgages usually come with lower interest rates and more standardized underwriting processes. On the other hand, commercial mortgages offer income-producing properties like office buildings, retail spaces, or multifamily units. These loans generally have shorter terms, and balloon payments are more common, The underwriting here shifts focus to property's net operating income, the debt service coverage ratio, and occupancy rates. Commercial loans usually feature higher interest rates, require larger down payments, and involve more negotiation. Understanding these differences is key to navigating real estate financing effectively. When it comes to credit scores and mortgage approval, having a better credit score can make a big difference. Higher scores generally unlock easier approval, lower interest rates, and stronger loan terms, which can save you a lot of money over time. Most lenders prefer borrowers who have at least fair to good credit, but the best pricing and deal options usually go to those with scores in the upper tiers. Looking at approval likelihood by credit score, if your score is 760 or above, you're in a very high approval category. Scores between 700 and 759 are also considered high, and you still have a good chance of approval with relatively favorable terms. Scores from 620 to 699 fall into a moderate approval range. These borrowers might face stricter conditions or higher rates. Below 620, approval chances are limited, and it can be much harder to qualify for a loan. It's important to remember that credit score isn't the only factor lenders consider. Income, your debt-to-income ratio, down payment size, and the type of loan you're applying for all play critical roles in the final decision. So, while improving your credit score is key, keeping your overall financial picture strong matters just as much in getting your mortgage approved. Let's talk about default risk and loss mitigation in real estate financing. Default happens when a borrower can't keep up with their mortgage payments. To manage this risk and minimize losses, lenders use several strategies that also aim to help borrowers avoid foreclosure. One common approach is loan modification. This involves changing the loan's interest rate, term, or even a balance to create a payment plan that's more affordable for the borrower. Another method is forbearance, where payments are temporarily reduced or paused. This gives the borrower some breathing room to recover from short-term financial difficulties. Lastly, there's the option of short sale. This happens when the property is sold for less than the amount owed on the loan, but only with the lender's approval. It's a way to cut losses while helping the borrower move on without foreclosure. These strategies are essential tools for both lenders and borrowers to manage default risks more effectively. Let's talk about mortgage-backed securities, or MBS. Essentially, an MBS bundles many individual mortgage loans into a single investment product. Here's how it works. Borrowers continue making their monthly principal and interest payments on their mortgages as usual. These loan payments then flow to the lender, who either pools these loans or sells them off as part of the MBS. Investors buy these securities, which means they receive income derived from the mortgage repayments. This setup creates a cash flow chain where the borrower's payments are passed through to the investors. One key point here is that investors gain exposure to real estate financing through mortgage payments, but they don't directly make the loans themselves. This structure helps channel funds from investors into the housing market efficiently while providing income opportunities tied to mortgage repayments. Here, we're focusing on the secondary mortgage market, which plays a crucial role in real estate financing. When lenders close a mortgage loan, they don't always keep it on their books. Instead, they sell these closed loans to investors or government agencies. This sale generates proceeds that lenders can use to provide new mortgages to other borrowers. This process is important because it replenishes capital, allowing lenders to continue offering loans without being tied up by one long-term mortgage. Additionally, by spreading the risk of these loans among many investors, the market gains liquidity, which strengthens the overall financial system. This liquidity supports broader access to credit, meaning more people can secure home financing. In essence, the secondary mortgage market keeps mortgage lending active and thriving well beyond the initial loan origination. Let's look at a case study comparing a fixed-rate mortgage and a 5-to-1 adjustable-rate mortgage, or ARM, based on a $400,000 loan held for 10 years. First, with the fixed-rate mortgage, the interest rate is locked at 6.2% for the entire 30-year term. This means the monthly payment remains consistent at $2,449 throughout the full 10-year holding period. Although the total interest paid over those 10 years is higher, approximately $236,000, there's no risk of payment increases. This option is ideal if you value stability and want to avoid surprises. On the other hand, the 5 to 1 ARM starts will lower initial rate of 4.8%, giving you a monthly payment of $2,098. This lower payment provides some early cash flow relief. However, the rate adjusts after year 5, so there's uncertainty beyond that point. If market rates stay moderate or decrease, total interest paid could range from about $191,000 to $219,000 over 10 years, potentially saving you money compared to the fixed rate. But if rates rise sharply, your payment could increase above the fixed mortgage amount up to $2,623, which means higher costs overall. In summary, the best choice depends largely on how interest rates move after the initial ARM period. The fixed rate mortgage offers predictability and peace of mind, while the ARM presents a chance for savings but comes with risk if rates climb. It's all about balancing your tolerance for uncertainty against potential financial benefits. Here, we're looking at a real-world investment decision involving a 12-unit rental property financed with debt. The key challenge is finding the right loan structure that strikes a balance between maximizing return potential and maintaining payment stability, all while protecting against downside risks. When considering ROI, it's crucial to compare leverage returns after accounting for debt service, fees, and total interest costs. Simply looking at property income won't give the full picture. The financing details play a big role in the actual returns. On the risk side, it's important to stress test various scenarios like vacancy rates, interest rate fluctuations, and refinancing exposure throughout the holding period. This helps us understand how resilient the investment will be under different market conditions. Cash flow is another essential factor. We need to ensure that net operating income reliably covers the monthly mortgage payments, preventing cash flow problems that could jeopardize the investment. Ultimately, this means evaluating the loan itself, not just the property. The financing terms can significantly impact the success and sustainability of the investment. Balancing these points allows for a smarter, more secure real estate investment decision. Now that we've covered the essentials, let's focus on the key takeaways from this module. First, you've learned to analyze different mortgage types, rate structures, and amortization methods to understand how these terms influence both cost and cash flow. This is crucial because the choice of mortgage impacts your financial strategy significantly. Next, you've gained the ability to calculate loan payments and total borrowing costs using core formulas and financial tools. This lets you precisely plan and manage your financing. You've also developed skills to evaluate various financing options by connecting payment schedules with long-term real estate outcomes, helping you make decisions that align with your investment goals. Additionally, you've learned to compare residential and commercial loans across factors like structure, performance, and flexibility, giving you a broader perspective to choose the right fit for different scenarios. Finally, you're now equipped to assess loan data, repayment forecasts, and risk trade-offs effectively, which is essential for supporting sound lending and investment decisions. These core skills empower you to interpret, calculate, and judge mortgage decisions confidently. Now that we've covered the core concepts, it's time to think about how to apply your knowledge in practical ways. First, practice loan calculations using real scenarios to get comfortable with the numbers. Next, analyze a mortgage offer to understand the terms and what they mean for your finances. Then, build an amortization schedule, which will help you see how payments are applied over time and how interest accrues. Finally, use what you've learned to evaluate investment opportunities, allowing you to make informed decisions in real estate financing. These steps will deepen your understanding and prepare you for real-world applications. Now, let's go over some valuable resources and tools you can use to deepen your understanding and sharpen your skills. First, there are several calculators that come in handy, like amortization calculators and mortgage payment calculators. These tools help you quickly break down loan payments over time, making complex numbers more manageable. You can also find spreadsheet loan models, which allow you to customize and analyze different financing scenarios in detail. Next, in terms of reading materials, I highly recommend the CFPB mortgage guides. They're comprehensive and easy to understand. You should also review lender term sheets and disclosures carefully, as these documents contain critical information that affects loan terms. Additionally, staying up to date with housing and commercial market reports can give you a broader context for financing decisions. Finally, the best way to really grasp these concepts is through practice. Try comparing fixed rate and adjustable rate mortgage scenarios to see how each impacts long term costs. Building amortization schedules by hand can reinforce your understanding of loan mechanics. Also, evaluating key metrics like loan to value ratio, debt service coverage ratio, and total interest paid will deepen your financial analysis skills. These steps will help you become more confident and effective in real estate financing.